Good morning and maybe good afternoon to a few of you guys. Welcome to our conference call. We were supposed to have David Moore joining us. He's a sponsor with a group called Skyline Pacific. And for some reason, he has not been able to join. I think he has technical difficulties. If he does join in, we'll bring him on. But for the time being, I'm thinking of just making this a question and answer for people asking questions about 1031s or Delaware statutory trusts. I'm sure if you guys are on this call, you may have some questions. We can do it through the chat window, or you guys can jump on and ask questions. I like to think that I'm an expert in this. I am the director of DSTs for Metric Financial. I'm the guy who does all the due diligence on it and for each of our offerings. And potentially I can help you guys with pretty much anything you want to ask today about 1031s and DSTs. You got anybody who wants to ask any questions? Hey, by the way, I see David here. Hey, David, how are things out in Columbia?
I think I had my mute on. Very good, thank you.
Oh, yeah, well, welcome, David. You're a repeat customer. I've seen you here a few times, and I think I've talked to you on the phone. How are things down in Columbia?
Very good. Weather's great. It's like San Diego weather, 70s all the time.
That works. I live just north of San Diego part of the year, so weather here is pretty nice. I can kind of get what you're talking about. Yeah. You guys have any questions? David, I know you might have a few. So
I probably will at the end of the webinar, so I'll just hang tight. Thank you.
Okay. Anybody else have questions? I figure maybe Vivian does. I see you're unmuted.
Hey, Mark. Let me see. I guess in terms of like biggest opportunities with DSTs, what do you see for like this coming year or next?
I feel like the market has turned a little bit. I think with interest rates kind of being capped out, I don't think they're going to continue to go up. I think they'll probably go down in the next 6 months. I think we'll probably have a rate reduction. I'm kind of hoping for July when they meet next, but I think it'll probably be the next meeting after that they do it. I think politically speaking, whether you like the current president or not, I think he's going to want to win election, and that would help. By the way, it looks like David has joined. I'm glad he could make it. David, I was going to do questions and answers because we were waiting for you, but I'd like to introduce David Moore, the guy running Pacific. Yes, glad you can make it.
Yeah, good to be here.
Okay, I'm going to give you a quick intro, Dave, and I'll let you take over, okay?
Sure. Give me a quick idea too. What you'd like to touch on?
Well, I'd like to get your perspective on the market, and I think you can talk about some of your past offerings. I know you don't want to talk about your current 506B, but we can avoid that since it's a 506B if you feel more comfortable with that. But I think we could talk about what's happening. What do you think is going to happen in the market, and we can go from there. David is the guy running Skyline Pacific. Last year we had an offering that was a gas station portfolio, which was pretty cool because it offered at the time potential bonus depreciation. You could put cash investments in and get a significant return in terms of depreciation. It was also a potential 1031 option for people who had loan exchanges where you could match capital gains with depreciation bonus losses. So, David, I'm going to give you the floor. By the way, David's a good guy. He's from Cleveland now, so go easy on him. He's a Browns fan. So,
I am.
but floor to you, David.
Yeah, no, thanks, Mark. I appreciate it. Yeah, I mean, really high level, my company specializes in net lease, primarily retail, but we do some office and industrial net lease as well, across really the lower 48. We're not really in Alaska or Hawaii very often, but we sort of specialize in buying net lease properties in bulk. You know, either from a REIT that might need to sell for some reason, or from a company that has a lot of corporate real estate that it wants to monetize and use the cash it gets from that monetization for other purposes, but lease the properties back under a net lease structure. So we end up with a lot of portfolios of retailers in the fast food industry, in the gas station, C-store industry, in retail bank branches, drugstores, that class of use generally. So we have a ton of experience in that area. We've acquired about 2,500 of those properties over the last 30 years, and held them, sold them to investors, put them into Delaware statutory trust investments, and kind of every other flavor in between. So we spend a lot of time in the market, looking at how net lease is performing, looking at how net lease can enhance portfolios, and still a big part of our business right now. And I'm happy, Mark, to kind of speak to market trends as I see them. But would love to understand what your team and the folks online here are most interested in hearing about.
Well, I think covering the where you think the market is going would be helpful. Most of the people on here, I believe, are looking at doing a 1031 exchange and considering DST options, but I don't speak for everybody here. But I'd like to get your input where you think the market's going and everything.
Yeah, sure. I mean, the biggest challenge at the moment is obviously high interest rates. I mean, commercial real estate investment's always been an interest rate driven segment. And so, the challenge that you get today is that most sellers are looking to sell a property at a cap rate or at a price that would not drive enough investment income to borrow current rates and create positive leverage from the loan. So you got this situation right now where there are a lot of people that want to buy commercial real estate, but the pricing that they can buy it at, given the interest rate they'd have to pay if they put financing on it, just doesn't produce particularly attractive return. And it's it's the opposite side of the coin for the sellers. There are a lot of people that want or need to sell a property, but can't get the pricing that they want to pay off an existing loan, or just to satisfy them that they're getting as good a deal as they think they would have gotten a year ago. So that's led to kind of a stall in transactions. There's just a lot less transaction volume right now than in the past couple of years, and that leads to challenges certainly in the Delaware statutory trust industry, in the sense that it's harder for sponsors to buy real estate at attractive prices and create Delaware statutory trusts that also have enough debt for a lot of 1031 buyers to trade into. And I am sure that will change over time here. I think that one of two or two of two things will happen. Either interest rates will come back down. I'm sure that'll happen to a degree, and or banks, the banks out there that traditionally make real estate loans in the kind of small and middle market investment space, they will start lending at higher volumes, and the rates will come down on the loans, even if overall interest rates don't come down. And that will help bring buyers and sellers together and probably increase the supply of attractive Delaware statutory trust and 1031 investment properties available out there in the market. But I wouldn't be surprised if that takes, 6, 12, maybe even 18 months to develop, to the point where you're seeing a lot of attractive investment options in the market again, the way you did a year ago. I know Mark's got a handful of offerings that may have been built 6 or 12 months ago, that he's the managing broker dealer on. And I think that some of those offerings that were built 6 or 12 months ago are probably particularly attractive, in the sense that both the financing and the purchase price were lined up to create positive leverage on the debt, and a nice investment product. But Mark can probably speak to that a little bit better than I can.
I do think there are a handful of good offerings out there. I personally don't think they're all good. We use a standard at Metric that all of our offerings are appropriate for some of our investors. So if it's something on our list and you guys see it, don't think that it's appropriate on every occasion. But I do think that I think there are some windows, some of the better offerings. I think the stuff coming out now will be better than stuff that came out a year ago, just because I think there are some corrections in the market for capital gains or cash cap rates, and I think that will be important. I'm still a little leery of the financial markets. I don't think bank lending is where it should be. I think there's still this view that they need interest rates to kind of come down before banks get back into the market in full. But I think that's I think that will change shortly.
Yeah, I mean, the banks are the traditional lenders for these sort of small and middle market real estate projects. Anything that's kind of like a $20 million to $50 million project that's looking for a loan about half that size, they're usually going to, regional or even community banks, sometimes credit unions, for that debt. And the problem that all of those lending institutions are facing right now is, one, they have older loans that are still on the books for everything from residential mortgages to other commercial real estate projects that they loaned on a few years ago. And those rates are so attractive to the borrowers that they're not refinancing, and they're not selling. So that's part of what's keeping those local banks out of the game, is that they have these on balance sheet loans at low interest rates, that the borrowers who took out those loans are just holding on to as long as they can. And in some cases, that's another year or two. Normally, some of those loans would be cycling, they'd get repaid, and the bank would have that money back to lend again. So that's part of, I think, what's keeping them on the sidelines. But the other piece is just, most of you probably have, kind of a high interest checking or savings account, or even a brokerage account. And those local, regional, community credit union banks, they have to pay you much higher interest rate on your deposits than they used to get money in the door. And so it's harder for them. They have higher operating costs, they have higher deposit costs than they did a couple of years ago. And then they have this book of loans in a lot of cases that are just slow to cycle. They're slow to get paid off because the borrowers love the rates and are happy where they are. So I hope you're right, Mark. I do think that lending will normalize, as I was alluding to earlier. Those banks are going to come back into the market, but it may take a little time for them to get some of these older loans to maturity that are still sitting on their books, and, not getting paid off as quickly as they might have underwritten them to get paid off. And then, the interest rates that we all see, the flip side of that for the banks is they gotta pay us more for our deposits. And that makes it harder for them to loan as well. They just have less free capital available to get out and put to work in real estate loans.
What kind of rates are you seeing right now? Have you gotten any quotes lately to see what is doable in the commercial space at this point?
Yeah, I mean, in the net lease space, most of those same banks that I'm talking about, when they are lending, are quoting anything from the mid sixes to the mid sevens. And that's still, that I probably wasn't totally clear earlier, but that rate, you're paying 6.5% to 7.5% every year for the money that you're borrowing. That rate is still higher than cap rates on a lot of the assets that trade regularly in the net lease space. You still might see gas stations trading for 5.25 cap. You might see a fast food restaurant trading for 5.5. You might see a Starbucks trading for 5.25. So you have this situation where if you go and buy something at 5.25, but you put 6.5% debt on it, you've got what's called negative leverage. You're paying more to borrow the money that you borrow than you get in investment return from the investment that you bought to finance with that money you borrow. And so it just makes it tough, I think, to put together a really attractive investment, whether you're talking about a 1031 of an entire property or whether you're talking about Delaware statutory trust. So I think that cap rates and lending rates will come into line one way or another. Either cap rates will move up or lending rates will move down, or a little bit of both. And as you're alluding to, Mark, you are seeing a little bit of that already.
I know you don't want to talk about your current offering, but I know you have your firm has a big position in Logan's steakhouses. Are you able to talk about Logan's in general?
I can talk about Logan's.
What's the plan?
Yeah, I mean, Logan's it's sort of a middle of the market steakhouse chain that's got operations in 22 states. It was recently acquired by the restaurant arm of a big private equity firm, Fortress Investment Group, that operates quite a few restaurants. They operate the Crystal's Burger chain and maybe half a dozen other steakhouses, including J. Alexander's and some higher end steakhouses as well. And Fortress is in sort of a different spot than the most recent ownership group of Logan's, in that, they not only operate what really is sort of core and best set of Logan's restaurants. They bought about 130 operating Logan's restaurants. They also operate another 100+ steakhouses. So they have a lot of efficiencies through that steakhouse network. And they operate about 500 restaurants under the same restaurant group, a group called SPB Hospitality. And so it's a really interesting company, and it's a really interesting opportunity that Fortress has to kind of leverage the scale of its hospitality business, its restaurant business, across these sort of 500 units that span most of the country, really. They can get sort of great efficiencies of scale. They have a good feel for a lot more markets than they would if they only had 130 restaurants operating, because they're in 500 markets across the different restaurants that they're operating through the same umbrella company. And it really presents, I think, a nice opportunity for a company like Logan's to grow, because they're operating through a bigger platform, 500 unit platform instead of a 130 unit platform, that can generate these sort of scale efficiencies. It can, scout other markets that Logan's might be really successful in. And that's something that I think is a real opportunity for Logan's in the sense that most of its competitors, you know, whether you're talking about a Texas Roadhouse, whether you're talking about a Logan Steakhouse, whether you're talking about a Longhorn Steakhouse, most of them have, you know, 500 or even 1,000 units in their chain. So, you know, Logan's coming in with only 130 units. Obviously, there are a lot of markets that they're not in yet. You know, that Fortress, I think, is looking to as expansion opportunities for Logan's. So I think in the long term, Logan's, you know, has a really good shot at becoming a much bigger company, a bigger credit, you know, as they describe it in the net lease world. And obviously that's, you know, that's a attractive opportunity for, you know, investors, whether you're, you know, a restaurant investor, whether you're a real estate investor, to take a harder look at the growth potential there and the efficiencies that being under SPV hospitality creates for Logan's.
Okay, what is the exit plan for Logan? Do you have any idea on that?
I don't. I mean, generally speaking, you know, private equity firms, their business plan is to buy a concept they think is undervalued, move forward with the sort of tactical plan or the tactical moves that they think will bring that concept from undervalued to its market value. Frequently, they'll also grow it, you know, so it's not just a static thing. And I'm sure that's a plan at Fortress with Logan's as well. You know, if you take a chain that's 100 units and you grow it to 200 units, obviously that gives them a much bigger business. And ultimately, they just look to exit it once they've sort of brought the concept to a higher valuation. And I suspect that, you know, that's the plan here. You know, the fact that they've rolled up 500 plus restaurants and multiple concepts under one operating company, you know, leads me to believe, although, you know, obviously I don't have their business plan, that they're, you know, ultimately looking for, you know, a sale to a larger restaurant group or a public exit. And either of those scenarios, you know, has potential positive repercussions on Logan's credit and Logan's long-term outlook.
Do you anticipate bringing out more Logan's in a DST at this point?
I don't have current plans to launch another DST in the near term. I'm sure we will next year, but you know, we'll have to take a hard look at the best net lease investments we have access to at that point and decide which of those makes sense to make part of a DST offering. And I think financing and, you know, and market trends are both going to have a strong impact on that. And it's hard to predict what those are going to look like in 2025.
Okay, do you have anything coming up soon? I know you'd mentioned you have a fund coming out as a 506C offering.
We are working on a 506C offering. It's going to be sort of a credit opportunities fund. And I don't have all the detail on that yet. We don't have the PPM put together, but generally speaking, you know, we're going to be looking, you know, through that offering, and you know, more broadly, to just take advantage of some of the market trends. I mean, the fact that the banks are so constrained in terms of their lending capacity right now creates a lot of opportunity in our minds for private capital to come in and make really safe loans at really attractive interest rates. You know, whether those are bridge loans or mezzanine loans or more traditional senior loans. So we'll take a look at that space. You know, we'll also look at bringing some private equity in for commercial real estate operators that just need an equity infusion. And one of the features of this market is as interest rates have increased and cap rates have also, kind of come up, is that a deal that might have been worth, $50 million in 2022 in the investment market might only be worth $40 million now. And so, those folks just to refinance are going to need an equity infusion. So there's also, we think, an opportunity to provide some private equity out there to small and middle market real estate operators at really attractive returns. So we're going to take a look at that space over the next 6 to 12 months, and we hope to have some offerings that look to capitalize on opportunities there.
Well, we're at about half an hour. I like to keep these for about half an hour and then maybe ask questions. But anybody on here want to ask David some questions or me any questions? We're going to open the floor up.
Yeah, happy to take any questions or cover anything, Mark, that you're thinking we haven't touched on yet.
Well, I guess I would ask, are you going to bring out any more gas station deals? Because I think with the bonus depreciation, they could be pretty favorable for this market.
Yeah, I mean, bonus depreciation is obviously really attractive for taxpayers that can use it. There are a couple different features of gas stations, convenience stores, car washes, those types of properties that are built into the tax code as it stands right now. That obviously everybody's got to kind of run through it with their own accountant. But if you can use those features, you can take depreciation very rapidly against investments in those asset classes, and your tax adjusted return in those assets becomes really attractive, higher than I think you can achieve otherwise in the investment real estate market. So that's something that a lot of operators in the real estate investment space take advantage of. I think there are a few offerings out there now from other sponsors that offer those types of opportunities. As Mark mentioned, we had an offering last year that was 12 gas stations, convenience stores, and qualified taxpayers were able to take, I'm guessing, really attractive returns out of that investment. There's also a more general rule of thumb with those same assets that says you can depreciate your investment over a 15-year horizon in some cases, versus other commercial properties that might have a depreciation schedule that's closer to 40 years. So essentially, you're just allowed to depreciate them much more quickly, even if you don't qualify for bonus depreciation. And there are a bunch of metrics that you'd have to run through with an accountant to figure that out. But even that 15-year accelerated depreciation schedule shelters all the income that you're likely to get from an investment in those asset classes, the gas station, C-store, car wash kind of space. And so those are something to keep an eye on and really understand the tax benefits of, if you have the right kind of investor, or you are the right kind of investor to take advantage of those benefits. And that's something, I mean, we trade as a company, we buy and sell a lot of gas stations and convenience stores. That's something that we will continue to look at as a potential offering in 2025 into the Delaware Statutory Trust space. But we don't have any current plans specifically to do that at this time.
Anybody else want to ask any questions? Looks like everybody's muted. Well, David, it looks like you've covered everything they want to hear about today, and we'll just wrap it up, but I do appreciate getting on the phone and talking with us for a while, and we'll just keep working on this. I appreciate everybody jumping on, and I did leave my contact info, marketmetric-financial.com is my email, and 760-594-0714 is my phone number. If you guys have any additional questions, feel free to reach out.
Yeah, thanks very much for tuning in, Mark. Thanks for the opportunity to talk to you and the other folks on the line here. And if somebody comes back to you later and wants to talk more about what we're doing as a company, current offerings, I'm happy to do that in that one-on-one context as well.
Sounds good. Thanks, everybody. Have a good day.